We had a question from one of our viewers that's about to retire. He said, I'm 6 months from retirement. I feel like the market is overvalued. Should I start to reduce my stock portfolio? We're going to review this situation and more, so stay tuned for the full segment. Welcome back. This is Richard with Wisdom Investor. Our viewer here is 6 months away from retirement and wants to make sure his portfolio is positioned just in case we get a downturn. So we're going to look at some factors here to be concerned with to help us determine when the market may start to turn down. If you have any comments you'd like to add to the video, leave your comments. They're much appreciated to all of us. Let's take a look at our U.S. Treasury 10-year to 3-month spread indicator. This is very reliable. You can see the gray bars that are vertical. That's when a recession occurs. When the 3-month T-bill starts to rise, you'll see that the chart shows that when these 3-month T-bill yields rise, almost immediately after that, then there is a recession. Now, if we look out to the far right, we can see right now that we're fairly valued. We're right on that midline. So right now, this indicator is not showing any signs of recession. Let's look at the U.S. Treasury yield curve. The blue line is a normal yield curve. The red line is an inverted curve. The blue line has the 3-month yield less than the 10-year yield. The red line shows the 3-month yield increasing and is more than the 10-year yield. When the red line situation starts to develop, that is going to be negative for our markets based on past history. Keep in mind the short-term rates are controlled by the Fed and the longer-term rates are typically controlled by market conditions. Let's just summarize here the situation regarding the 3-month and the 10-year yield. When the 3-month yield is greater than the 10-year, that's going to be a bearish sign for the markets. Right now, the 10-year yield is 1.64% and the 3-month yield is 0.06%. So based on this first indicator, I wouldn't make any drastic moves. We're going to look at 2 other indicators here. This next indicator we're going to look at is the S&P 500 mean regression. It sounds complicated, but it's not. If we look out to the far right, we'll see that the S&P 500 is overvalued. I think a lot of people already have that figured out. What this means is that the S&P 500 will eventually return to its long-term trend line, which is the middle dotted line. So what does that mean for the S&P 500? That means the S&P 500 could eventually come back down to 2,300. Right now it's at 4,500. So that is where the market could potentially go, but we're going to have various conditions to trigger that to happen. We're looking at the chart for the 30-year mortgage rates. If we look at the bottom right, inside the circle there, we can see the rates starting to slightly turn up. As we said earlier, the Fed controls the short-term rates. They're not planning on increasing those yet, although we've all heard and seen inflation. If inflation starts to pick up and starts to move higher, Fed may be forced to move interest rates higher, and also market conditions control the mortgage rates, which is typically representative of the 10-year Treasury bond yield. So if the 10-year yield starts to increase due to market conditions and the mortgage rates increase, that may trigger selling in the markets. It would certainly slow down housing, and it could also slow down construction. The last indicator to look at is the unemployment rate. If unemployment starts to increase, interest rates start to go higher, that could be the nail in the coffin for the markets. Now, for our viewer here, I was starting to lighten up. If he's 100% invested, maybe 70-30 ratio right now, even 60-40 would be okay. I think it'd be smart to get out of aggressive investments. Tech stocks would definitely suffer if interest rates start to go higher. They're very speculative. Also, if he can get involved in a good mutual fund or ETF that's an equity income fund that's balanced, that I think would be the best choice for right now. If you have any comments, leave your comments. Stay tuned for our next episode.